Good afternoon, everyone. Welcome to the second Power Hour of the year, Renewable Energy Projects Financing on Distributed Solar. My name is Megha Hamal. I am the Chief Strategy and Communications Officer for the Illinois Power Agency, and I will be responsible for hosting the presentation today. To get started, let's go over some housekeeping items. To reduce any background noise, we have muted participants upon entry. We will be taking questions towards the end, but if you have a questions for our speakers during the webinar, please go ahead and submit your questions on the chat window on the Zoom panel. And if our speakers have time, they will answer those questions throughout the webinar. If not, then we will be allocating about 12 to 13 minutes towards the end for the questions. As you know, today's session is being recorded, and a copy of the recording and the presentation will be available on the IPA website under events. Couple of points that I would like to emphasize. Today's webinar, Renewable Energy Projects Financing for Distributed Solar, is for general education purpose only and does not represent a legal representation or interpretation or statement of policy by the agency or its staff. This 60-minute webinar will explore the financing models for distributed generation solar projects, including key players in the industry. Additionally, speakers will focus on financing process, risks, and capital stack for DG Solar. For those who are new to our Power Hour webinars, this is a series of educational and informative webinars on a range of clean energy topics and emerging issues. We started this webinar in 2021 when Climate and Equitable Jobs Act, also known as CEJA, was enacted. To date, the agency has hosted 29 Power Hour webinars, and we've invited energy thought leaders and experts locally and nationally. I have included a link to the webinar archives. So if you have not listened to one of our webinars in the past or watched them, please go ahead and click that link, which will take you to an event page with webinars from the past. I would like to then let you all know that this is the upcoming Power Hour webinar for April, and it is taking place on April 26th, and it will be on climate change and health equity. So those who are new to our webinars and just our agency, I just want to give a quick overview on who we are. The Illinois Power Agency is an independent state agency established under Illinois law in 2007. We are responsible for the development of the annual electricity procurement plan for customers of Illinois electric utilities. We also support the Illinois Renewable Portfolio Standard, which is public policy designed to increase the implementation of renewables in Illinois. And we support the RPS through the long-term renewable resources procurement plan. We also support the RPS by conducting competitive procurement for utility scale projects. And we also support the RPS through the solar programs, incentive solar programs like Illinois Shines and Illinois Solar for All that support homes and businesses. So with that, I want to do a quick welcome for our speakers that are here today to talk about this webinar. Our first speaker for this session is Chandrika Mittal. Chandrika is Illinois Power Agency's Director of Renewable Energy Finance. Prior to joining the IPA, Chandrika was a vice president at True Green Capital, an energy infrastructure private equity firm. Chandrika started her career as an investment banker focused on raising capital in the energy and infrastructure space. Welcome, Chandrika.
Thanks, Megha.
Our next speaker is Rohan Saharia, Partner and Accounting Director at the Environmental Resources Management ERM International Group, a global sustainability consulting firm headquartered in London. Prior to joining ERM, Rohan led the deal team for a mid market infrastructure investment in solar, storage development, and assets. Prior to that, Rohan was a strategy and operations consultant at McKinsey. Welcome, Rohan.
Thank you, Mega. Pleasure to be here.
Now, I would like to welcome our first speaker, Chandrika, to kick off the presentation by giving an overview on the different types of solar projects and financing options. Chandrika.
Thanks, Mega. Hi, everyone. Before we jump to the meat of the matter on financing, I do want to set the stage and talk about what exactly DG Solar means, but also emphasize that in today's presentation, we'll be talking about general market trends and financing for DG projects in general, not really state-specific as some of our past webinars have been. So to talk about financing for DG Solar projects, some of you or most of you probably already know this, and we've done previous webinars on these topics, so I won't go into much detail, but solar is typically categorized into three different categories by size: your utility scale, distributed generation, or commercial and industrial, C&I solar, as it's also known in the space, and residential. Utility scale is usually your large, think of hundreds of megawatts of solar, usually 10 plus megawatts. DG specifically refers to projects that are typically 5 megawatts or lower, and residential, think of much smaller in your tens or maybe hundreds of kilowatts. Next slide, please. Before we talk about financing from a developer's perspective or a project finance perspective, most of us understand solar financing as a customer's perspective, which is more like, hey, I have a home, I want to put solar on the home. What options do I have? And those typically is like your power purchase agreements, your leases, loans, or cash purchase. We will not be talking about that today. IPA did actually do a webinar on that earlier. It's linked on this slide deck. So if that's what you're interested in, please refer to that specific webinar. Next slide, please. Okay, so before we talk about how these projects are financed or how a developer goes about financing these projects, we do need to identify who we're talking about, why they matter, and what role they play in a specific renewable energy project, specifically for distributed generation. So key players fall into three different categories, one being the developer, which is essentially the construction, financing, installer, sometimes can wear multiple hats, but it's effectively the person building or the company building this project. The developers highlighted here are just some random developers we picked, which are active in the space of DG Solar in Illinois, and actually a registered approved vendor. We have three different types of financiers. I'll get to that in a minute. And then most importantly, we have something that's an off-taker. So most times when a developer goes about a DG Solar project, they sign something called a power purchase agreement, which is one of the most important aspects of financing from a contract perspective, as that's your main key revenue piece. It's the entity buying the power that's generated from this DG project. And most times these entities look like, for C&I Solar, DG Solar, your giant corporates that we all know of. In fact, all the entities listed on here do have active solar projects in the state of Illinois. Now, coming back to the piece that we all want to talk about, when we go about financing a DG Solar project, there's essentially three large buckets or three financing partners involved. And Rohan will touch on this in a lot more detail, but I do want to introduce them. One bucket is called sponsor equity, sometimes also called as cash equity. Another bucket is debt, and another bucket is tax equity. Sponsor equity, most times in case of a larger developer, just tends to be the developer themselves. But if you're thinking of more a mom and pop or a smaller scale DG Solar developer that may not necessarily have the financing in place, they go out looking for an equity partner, which tends to be the sponsor equity. So from this point onwards, when we talk about who owns the project, it's usually the sponsor equity we're referring to. And these firms tend to be, like I said, the developer themselves, if they're well-funded, well-capitalized, or in many cases, they will partner with your large asset management firms, real estate investment trusts, international funds, sovereign wealth funds. These are actively the players that are funding these projects as a sponsor equity. Debt is very typical to like how we finance a car or a home. These tend to be your large national banks. It could be a local bank that the developer has good relationships with. It could be a local credit union. Tax equity is the most unique piece to renewable energy projects. So as probably most of us on the call understand that we have a federal incentive known as an investment tax credit, ITC, for solar projects, which is essentially a dollar for dollar credit that you get to monetize if you have the taxable income. Most developers or even sponsor equity may or may not have the taxable income to monetize or take advantage of these investment tax credits that are available, which is why for solar, a lot of these developers will go ahead and partner with a tax equity provider. And these tend to be your really large national banks with hundreds of millions of dollars in taxable income. Sometimes, and more so now, there's roofing companies or sophisticated private capital entering the space, but it's usually dominated by your large national banks. So that's basically kind of who the players are. Can we go on the next slide, please? To understand how a developer goes about financing a project, we need to understand two main business models that exist for most developers operating in this space. Not saying there's no other business model, but again, these are the two more popular business models. One is the owner-operator business model, and one is called the develop and flip business model. Owner and operator, like the name suggests, these are your kind of large, really large developers, sometimes even public developers. These tend to be the long-term owners of the project, think 10 plus years. Most of us, I'm assuming, already know that a PPA or a standard PPA term for a power purchase agreement is usually 15 to 25 years, depending on who your off-taker is. So these are the developers that tend to stay for the term of the PPA or most of it. They are more likely to have sophisticated long-term financing in place, and they're not necessarily going out to finance per project or per portfolio. What that really means is a lot of these developers either have enough capital on their balance sheets to build these projects themselves, or they already have large partnerships with some of these investment management firms or larger tax equity partnerships that they deploy on a fund basis. All that to say that these are generally your larger developers. They tend to construct or have their own funds for construction. They also tend to have what we call O&M, operations and maintenance verticals or subsidiaries. So think once you go with a developer that size, they are kind of holding on to the project, servicing the project after operation, and are in it basically for what I would say the long haul. The other project or other business model is develop and flip. These are, as the name suggests, developers that tend to develop the projects up to a certain stage and then will sell the project to a different sponsor equity. As we understood earlier, sponsor equity is who we define as the true owner or the long-term owner of the project. When the sale happens is very, very dependent on the developer, the project, when they're able to find financing, and it's not really set in stone, but typically it's either post-construction or sometimes even pre-construction. So pre-construction would be your early stage sell, and your post-construction is primarily an operating project that you sell. These developers tend to raise financing on a per project or per portfolio basis. Realistically tends to be more on a per portfolio basis. The reason being that there's so many entities involved, from like third-party consultants, bankers, lawyers, in the financing of a single transaction or a project. It usually makes more sense financially from a capital efficiency perspective to finance on a portfolio basis. And what that means is they will try to group together different projects which have a similar risk appetite. So think that the off-taker or the person or the company buying the power has a very similar profile. So they will usually collaborate and combine those projects under one portfolio and then go out and raise funding just for capital efficiency purposes. These style of developers also tend to not have your large O&M teams or O&M verticals, so which means that the project is changing hands at different points. So once it's post-operation, they're usually contracting with a third-party O&M provider to service the project. Now that we understand the two main models, we will go through the project life cycle and we will talk about at what point they raised financing and why it was important for us to understand the different business models, because that differentiates at what point they will raise financing in the life cycle of a solar project. So can we go to the next slide, please? Thank you. So DG solar project life cycle usually has three main pieces: your development, construction, and operation. These steps may not necessarily happen in the order you see on the screen, and I will go into why that may be the case, but most likely for a plain vanilla project, majority of the projects, these are the steps that it will likely follow. So development is usually your early stage site selection, offtake, and even some early stage permitting. Construction is when, or pre-construction or right at construction is when a lot of the financing and actual construction will happen. And then operation is when the project is finally producing energy. So how does the developer go about selecting site? For a DG solar project, there's a lot of factors at play. For example, your local power prices, your local incentives, such as the Illinois Shines incentive in the state of Illinois, solar radiation, topography, etc. But many times they will secure a site lease and most likely a PPA at the same time, because in the world of commercial, industrial, or C&I solar, or distributed generation, whatever we want to call it, you're most likely signing with a corporate off-taker, which means the project is, let's say, located on the roof of an Amazon warehouse or at a data center for Meta, which means your site and your power purchasers most likely the same entity. But usually you will go around finalizing your site first, securing a site lease. You usually don't buy the site. At that point, you will also sign the power purchase agreement, like I said, between 15 to 25 years with the corporation, or sometimes it can look like a local utility, a municipality, a cooperative. Once you have these early development pieces sorted, now comes time to apply for permitting. One of the most important permits is interconnection, which also can cost hundreds and thousands of dollars. So if we're talking about an owner-operator business model for a developer, that may or may not be a problem. But if we're talking more your bootstrap, smaller DG solar developer, they may not always have hundreds and thousands of dollars to apply or submit with the interconnection application, at which point they will go for financing the project, at which point they will most likely either try to finance for all three pieces at the same time. Usually makes the most financial sense from an efficiency perspective, but may not always line up that way. But at this point, they will partner with a sponsor equity firm that will help pay for these expenses within permitting and construction. They will go out and primarily even earlier could go out and get debt. Something to understand about financing for renewable energy projects is the debt or the equity is not collateralized on anything outside of the actual project. So revenue from the project is your collateral. So that's typically how you get debt based on, it's basically a hedge based on future revenue. And then ultimately, tax equity is usually coming in or deploying the capital much later, once the project is usually closer to construction, and they will be the ones monetizing the investment tax credit we talked about. So once you have your financing in place, you can go ahead and start applying for permits, interconnection, electrical permits, building permits, engineering drawings, your titles, your surveys, all of those pieces. Some of these activities may also happen in parallel, where we are raising financing, we're starting to apply for permits. Once certain permits come in, we're trying to start construction. Now, usually, again, most of these developers will subcontract the construction piece to a construction company, unless you're an EPC style developer, which is engineering, procurement, construction, which means you self-perform most of these functions. Usually for like a 2 megawatt size project, your most standard DG solar project will take you maybe 3 to 6 months for construction, depending on the environment we're in, labor availability, and a lot of these other factors. But this does not account for the permitting time, which may take a lot longer. To complicate the matters more, a developer may also go out and obtain a construction loan if they want to, let's say, get started with construction, but they don't have their financing in place, which is usually a more expensive loan. We're already in a very high debt interest rate environment, so the construction loan is usually not the first option, but something that developers have to do. And many times this construction loan will convert into post-construction debt. So the construction loan converts into what we call term debt, which is debt on the project. At this point, once the project is constructed and operating, if you're a bootstrap or an own and flip, or sorry, a develop and flip style developer, you will either flip the project somewhere between permitting and construction, or you will flip after construction, just depending on what works in the market, what financing you could find, what your business model is. But if you're an owner-operator style developer, you will continue to hold on to the project for a long time and may actually even sell that project, but that would be much, much later down the line, I think 10, 15 years down the line. So that's typically what a life cycle of a project looks like. Now, to enter more into financing details, what the parties are, what are the risks of financing, and to talk a little bit more about cost of capital, I will pass it on to Rohan. Thank you.
Thanks, Chandrika. Before I start with this section, I'll just say this is a wide topic, and we've tried to keep it accessible and general, just given the wide audience here. So when you do that, there's always the risk that you paint with such broad brushstrokes that you gloss over important details. Very much welcome your questions. If anything's unclear, I've got the chat window open here, but there's also time at the back end. We're going to save about 10 minutes for Q&A. So whatever suits you best, please feel free to ask accordingly. Let's jump into the next slide. And this one, it's kind of a slightly different look along the life cycle of an asset, but a different asset. This is home, which feels a little more accessible and familiar for a large number of folks over here. There are a lot of parallels between this and a solar financing, though. And I think it's helpful if you think of it from a home which is under development, so not necessarily a home which already exists, you're buying from another seller. There are a lot of features you'll find are very similar when you think of financing a solar project. So the most common piece, I think most people are, or the pieces that most people are familiar with, is the equity, which is, let's say, the down payment or the amount of capital they put into a project, and raising mortgage or debt against that. So let's say you have at the outset a project which is under development. A developer is putting a site together. You put a down payment which kind of secures your position in that, or a certain lot in that project. At the bottom, you'll see the capital stack. That's essentially starting to link it a bit to the world of solar. We would call the equity payment, which is put down by the future homeowner, the sponsor equity in this case. There's also a sliver of capital which is put down by the developer. So they might have acquired the land. They might be paying some capital to develop the project over there. So at this point, essentially, you've got a combination of the homeowner's equity and the developer, which is forming the capital stack. Capital stack is nothing more than the different pieces of who owns the different pieces of the pie. And in this case, it's still very low because you have something which is not, it's coming together, but it's not a real home yet. The next stage is construction. So at this point, the developer might reach into their pockets and start building. They might use some of the sponsor equity from the down payment, which they had during the development phase. But you see that that capital stack is starting to grow. So as the home starts to become a little more real, you have the value of the project or the value of the asset going up. And then all the way, once the construction's done, all the way to the right, you'll see a full purchase. So at this point, it's an actual asset, it's a home. Let's say the remainder of the equity, which the player want, or in this case, the homeowner wants to put in, another 10% is put down. They'll then go and have the debt finance the rest of the amount. So if you have another 70%, 30% has come from the equity, the debt will form the rest of the 70%. And now you start seeing towards the right-hand side, the capital stack, the developers being pretty much fully paid off. And at this point, the homeowner has the equity, which is the light blue sliver at the top, and they've got a bunch of debt on the property, which they'll pay off in due course of time. This is a typical asset financing cycle, and whether you think of it in terms of a home or you replace that with a solar project, you'll see a lot of parallels. A couple of questions to ask ourselves at this stage, and I won't answer them now necessarily. We'll go through that when we talk about solar. But why does the bank want sponsor equity? Why can the bank not just put 100% debt and have the homeowner live there? In that case, they're not really an owner. The bank owns the property. But what's the advantage of having some equity ownership? And another thing to consider over here is in case of a default, let's say the homeowner defaults, what recourses do the banks who provided the term debt typically have? So just hold on maybe to those two thoughts as we go through the next few pages. So if we hop onto the next page, we'll start layering in the concept of de-risking of an asset. And again, it kind of happened with the home loan on the previous, or the home on the previous page. On this page, we're starting to get into the solar world a bit. Right on the left-hand side, you have, when the project is under development, it's rife with risk. Everything's a risk basically at that point because it's an idea which is coming together. As you enter the construction phase, typically what happens is, as Chandrika walked us through the different steps, you have site control. And this is a developer who's typically putting this together. They've got the site control, you've got your revenue, which is the offtake, someone's going to pay for the power. You've got the permitting typically in place. You've got interconnection, so you can connect to the grid typically, and you've got some of the financing knocked down. So your risk has started to, the number of items in your risk profile are starting to diminish. As you proceed, commercialization happens. So you've built the project, that risk disappears. And as you move to the right, during operation phase, you now have an operating asset and a lot of the previous risk has disappeared. It's just about operating the asset and making sure that you can actually harness the energy and produce power on a regular basis. So if we jump to the next slide, what we'll see is the reduction in risk. Can we head to the next slide, please? The reduction in risk over time from the development through construction, commercialization, and operation has an impact in the cost of capital. And by cost of capital, the easiest way to think of it is what's the rate of the loan you would have to take out to fund that stage of development. So as the risk is going down, the cost of capital is also going down. And this is an essential concept to understand because this is really what creates value. So if you think of the home example, when there was a little more than a piece of land to when there was actually a constructed property, the value went up. A big piece of that is because the cost of capital has come down. So that's another way to think of it, that you're creating value by de-risking the project. This is a concept you'll see come up on the next page as well. And the next page, as we move over here, we'll talk, it has a few parallels if you think back a couple of slides ago with the home ownership process. So you'll see a couple of similar boxes in the capital stack. We talked about the developer, the sponsor equity, and term debt. When we are thinking about a home, there's a new player we've added in over here, the purple color box, which is tax equity. I'll get to that in a minute, but it's a similar evolution. So you first have the developer who has a piece of owns basically all of the asset at that point, which is, again, a little more than an idea. As the sponsor comes in at the next stage during construction, let's say, or just before construction, the value is increased because it started to become a little more real. At commercialization, when you switch the project on, tax equity typically comes in, and there's a little more value. And as you have an operating asset, right, towards the right-hand side of the chevron bars, you'll see the value has increased and you have term debt, which is starting to come on. Very similar to what we saw happen with the home. I think a few things to point out over here. So number one, as the risk is going down, the value of a solar project is increasing over time. The second is there are very many different players involved in the capital stack. So you have the developer at the beginning, you have a sponsor equity, you have the term debt, and another player we've introduced over here, the tax equity investor. What this means is the same project will be looked at by a number of different people. And so the financing process can look pretty complex. It can also feel a little repetitive for the developers because they're answering a lot of the same questions. But the different financiers coming in have a different place in the capital stack. And therefore, they look at the risk and their exposure a little differently. Something to point out is the sponsor equity, the blue bar over here, that remains constant through the construction, commercialization, and operation phase. So they're, in a way, the long-term holders of the assets. Chandrika mentioned this earlier as well. This is a flavor. It's a very common flavor, but a flavor of financing projects. This is the it has different variations as well, right? And there are tons of nuance. There are different ways of financing this. It's a very common flavor, but in this, the sponsor equity is the longer term owner, and they bring in other partners, tax equity partners, or the debt, much like a homeowner would have a mortgage brought onto their property. The Another thing to point out over here is the sponsor equity has a good amount of their capital brought in during the construction phase, but even though they're creating value, so the overall capital stack of a project has gone up over time, you see their share of capital in that has diminished. And this is a critical point. This is how sponsor equity creates value. They de-risk a project during the construction phase. And when the commercialization and operation, the subsequent phases which have less risk are brought about, they're able to take some of their capital out and bring in tax equity and term debt. What this means is they can take that capital they've got out of this project and repeat the process with other projects or portfolios. And this is how a large number of sponsor equity financiers create value. We'll see a little more about this on the next page, but I'll bring back some of the questions I asked a couple of slides ago, which is why would a bank, which is providing the debt, want a sponsor equity to maintain some value or some part of the capital stack? And the answer to that is skin in the game. So the sponsor equity over here is the one who kind of owns the solar project over its life after the developer has been paid off and they're off doing further development work, doing the same thing. They also are developing more projects like the sponsor equity does once their capital has been taken out. But they want to make sure the sponsor equity remains in the capital stack typically so that they have skin in the game. And what that means is they make sure that the solar asset is operating correctly, generating cash flows. And because the bank's not always going to run the project. In fact, very rarely does the bank run the project. Same for the tax equity. The sponsor equity is still the one running the project, and they want to make sure that they have incentive to keep the asset running as efficiently and as productively as possible. The other piece to call out over here, the second question which we had on the previous page was, why does the value of the project, or what is in case of a default, what is the recourse that the term debt has available to it? The answer typically in project finance is it's non-recourse term debt. So what that means is if the sponsor stops sort of paying for the mortgage or the debt principal as well as the interest, the term debt has recourse which is limited to the asset itself. So in a home example, there are different variations of this, but in a non-recourse home financing, typically you will have the mortgage will come in and secure the asset or foreclose on the home in that case, and not have recourse beyond that to the personal balance sheet of the homeowner. It's similar here, which is the term debt and the tax equity as well typically have limited recourse in that they can only seize the asset. And what that means is when they are underwriting and they're deciding whether they want to put a certain amount of debt on a project, they have to size that correctly, which is they don't want it to be beyond a certain amount, because if the project goes below water, they can only secure the project and not much more to recoup their funds. And the second piece is the contract of the documents for the project become everything. They become the source of truth, which the bank and the tax equity want to get into in a good amount of detail, because that really is their backstop. They don't have much recourse beyond that. Again, this is one flavor of project finance. There are some recourse forms of project finance as well, but this is one of the more common ones, especially when you think of a certain project or a portfolio. If we move to the next page, we'll see how different macro trends will change the capital stack, both in terms of the value, so the size of the valuation of the asset and how lucrative that asset is, but also the ratio of the different players who are occupying that capital stack. So let's start with a base case. And let's just, for discussion's sake, assume this is exactly what we had on the previous page. You have tax equity, you have term debt, and sponsor equity, three players who are occupying the capital stack for an operating asset. The tax equity is a unique feature which is brought about by the fact that uh, solar projects are subject to production tax credits or income tax credits. And typically the sponsor equity, who would be an investment firm, doesn't, or not typically, but very often, they do not have their own tax liabilities. So they don't have they don't have the ability to absorb the tax credits which are being generated. They then need to find folks or investors who do have a tax liability so they can literally sell the credits to them or have them monetize the credits. That's why the tax equity comes in. I'll note over here that with the recent Inflation Reduction Act, it's become a lot more liquid. You don't even necessarily need to have a tax equity investor. You could just sell the credits. It gets a little nuanced, but that is a variation over here. For simplicity, let's just assume that there's still tax equity investors in the project. We'll flex this base case a bit to the right-hand side. So let's say that you have IRA adders. And what adders are is essentially, let's say you're getting a 30% credits on the capex, eligible capex for a project. If you are in a low to moderate income zone, or you are in an energy community, or if you're using domestic content made in the US, you're eligible for certain adders. So instead of, let's say, that 30%, you might be able to get 50% tax credits. Essentially, the simple way to think about it is whatever your eligible capex is, you're able to knock off, if not 30%, another 20%. So 50% of the cost and recoup some of that. This is critical because what it does is the lower the capex, obviously, the higher the value of the project. So in this case, on the right-hand side, when you've added more value by having more tax credits, clearly the tax equity will increase and the size of the pie increases and tax equity share in that size of the pie can go up. In reality, the sponsor equity or the term debt will recoup a lot of that value. But again, for simplicity, let's just assume over here that the tax equity is grown. On the left-hand side, let's say the federal rate have decreased. Interest rates are a hot topic these days. And given the high rates, what happens is, much like home loans, you can only raise a certain amount of debt. If your interest rates were to go down, you'll be able to raise a large amount of debt. The effect that has is the more debt you raise, the size or the valuation of the asset also goes up. So you see over here how different macro trends have an impact on the size of the asset and also the attribution of different capital players or different players in the capital stack. If we flip to the next page, having seen how a project evolves and the different players who are involved, we take a look at who these players are. So we talked about the sponsor equity, we talked about debt providers and tax equity providers. On the right-hand side, you'll see examples of companies or financiers who typically play these roles. A sponsor equity would be someone like a Brookfield or a Generate or an Altus Power. These are typically large private funds. They have investors who, in turn, are large pension funds, let's say, put money into these private equity companies or these private players. And these asset managers then deploy capital to help construct and build portfolio companies and then repeat that process like we saw on the past few pages. The next, and the risk they take is some of the highest in just the general financing sense of the process. The debt providers that you have on the next in the next row are typically coming in at when the asset is operating. So it's a little lower, the type of risk they take. These are large banks like CIT, First Citizens Bank, which bought Silicon Valley Bank, and they're typically involved for the longer term. So they'll have term debt over there, but they're not the most risk taking, very similar to the mortgage you have on your home, probably. And after that, you have the tax equity provider. It's actually closer to the sponsor equity in certain ways, but depending on the kind of tax equity provider you have, they also are typically taking very, very little risk. Even though they're equity, they're taking very, very little risk. And these will typically be large banks like US Bank, Bank of America, MUFG, which either have their own tax liabilities or syndicate tax liabilities um, of other large set of high net worth individuals or corporate tax paying clients. Um, Again, the thing to point out here is because of how much tax and how much recourse they have, which is very limited, it's limited to the assets. Debt and tax equity will be very, very involved in the projects themselves and will underwrite based on their confidence and sort of security which they get in the asset itself, because very often they do not have a recourse. If that asset was to fall apart, not produce, they don't have much recourse beyond that. And that, I think, is the last page in my section. So I'll invite Chandrika back to summarize and conclude.
Thanks, Rohan. Can we go to the next slide, please? So I think that was probably a lot to unpack for most people, but I will run through really quickly what we discussed. Specifically, what Rohan discussed is that was kind of more our meat of the matter. Financing a DG solar project is, like Rohan said, for very layman terms, kind of like financing a home. You have different entities, you take on debt, you're paying that over a certain period of time, long term, similar to a DG solar project. As the project progresses in its life cycle, the level of risk reduces. And what that means for a financier is as the risk goes down, the cost of capital goes down. And what that basically essentially means is there's more value being created overall. As you've seen, different players come in at different times in the project development life cycle. That's what we mean when we say the capital stack evolves over time. And that's more a function of what role they're playing or what role their capital is playing in the project, how that's deployed, and where how they're getting or making up the investment that they put in. Project financing is very, very heavily dependent on a lot of the external factors. So our federal interest rates, our federal incentives, our local incentive programs, the IRA. So specifically for Illinois, for example, what two main pieces, and kind of tying this back to how it affects players in the state of Illinois, the two main pieces of revenue for a project is your power purchase agreement, so your PPA, and then there's also something that most of us understand called RECs, Renewable Energy Certificates. Those are your two main revenue pieces of a project. So every financier that's coming in is looking at what is the income that the project is bringing in, which means they're looking at what is that price, $1 per megawatt hour price that the project is receiving in the form of the person or the entity buying the power, so the PPA. And then the second piece is, what is the REC market like? How can we monetize these RECs? What is the dollar value that the RECs are producing? In the case of Illinois, that means what is the dollar per REC, let's say for when you sign up for your Illinois Shines or the Adjustable Buck program as it was formerly known. What is that dollar per REC that your project can get, which defines or drives a lot of the value that the project is bringing in, which is why these incentives are really important to a lot of the DG developers. And then that ties into what kind of financing we can get. Like we talked about, there's three main investors: your sponsor equity, tax equity, and debt. We didn't go into this in a lot of detail, but like Rohan mentioned, the IRA, the main outside of the adders that are present for tax equity, the domestic content and the equitable environmental justice community adder, I think the tax equity role is changing in real time as we speak with the ability to transfer tax credits, and that's something we've not touched a lot in this webinar. This is a more traditional model of sponsor tax and debt, but that is truly changing in real time, and that's a topic for another day. But can we go to the next slide, please? So to summarize, and if you want to leave with one picture in your mind when you try to understand what renewable energy financing is, I do want to mention that while we're talking about DG solar and there's parts of it that's applicable more to DG than, let's say, utility or to wind, this structure is pretty much what we call structured finance or project finance structure. So it could technically, theoretically be a wind or a solar project, but the way it is set up for tax purposes or for financing structure purposes, the entities come together to form what we call a partnership for US tax purposes, or a special purpose vehicle or a special purpose entity. There's sponsor equity and tax equity partners that contribute capital into this partnership. So that's the capital contribution going in. Sponsor equity may put in anywhere from 20 to 50% of the capital costs, depending on the environment we're in. In a development flip model, the sponsor equity basically buys out the developer, gives them essentially a developer fee, and then is basically the long-term owner of the project. In an owner-operator model, the sponsor equity is essentially the developer that is staying through the project. A tax equity partner, like we mentioned, most owners of renewable energy projects or sponsor equities do not have the taxable income to monetize the investment tax credits. And why is it important to monetize the investment tax credits? Because that's bringing a whole lot of value to your project. That's basically, if you were to not monetize it, you're leaving free money on the table. So, and it's a decent chunk. So it's very important for us to be able to monetize tax equity. So tax equity typically contributes some capital into the project as well, usually similar to what the ITC is. So let's say about 30%. In return, what they get, both tax equity and sponsor equity, is tax equity gets most of the tax credits. Sometimes sponsor equity will get a very, very small percentage of the tax credits as well. They both get cash distributions from the project or the taxable income from the project as well. So if you're talking specifically from the US tax code perspective, those are two different aspects that they're getting back, or what they're getting in return and how they're making up their internal rate of return or IRR. Debt is a little unique for project finance, where most debt is usually what we call back-levered debt. There's two types of debt called project level debt or back-levered debt. Back-levered debt is what we typically see in project finance, and all that means is usually if the project were to liquidate, your debt provider gets paid first, but that's not the case in project finance. Usually if the project were to liquidate, the order of getting paid out, the tax equity will come before debt, which is why we call it back-levered debt. If we're in a debt-friendly environment, you can have debt ranging in a higher percentage. We're not in a debt-friendly environment, so debt on projects will typically be lower. So anywhere, I think between 20 to 50% would be debt on the project. Again, 20 to 50% would be sponsor equity, depending on the environment we're in, and the remaining about 30% is tax equity. So like I said, if anything you want to take away, this is the structure to take away from this discussion. But I will now pause because this is the end of our presentation. And I do want to make sure we have time to address any questions that anyone might have. And I'll let Megha announce how we want questions coming in. Thank you.
Thank you. Thanks, Chandrika. Thanks, Rohan. I was just looking at the chat. We haven't gotten any questions, but we have a little bit of time, so maybe we can give it a little, maybe a few more minutes. But Chandrika, this was something you and I were discussing as we were waiting for the questions. with this topic, we wanted to sort of set the stage on what renewable energy projects financing look like, sort of overarching. But of course, maybe at a later date, maybe in fall, we can sort of zone in on like Illinois specific. And maybe if you could talk a little bit about that, because we could, just given the 1 hour, we couldn't pack everything in one setting. So I just
Oh,
want to.
absolutely. Yes, I do want to mention, I think, so while this model is applicable in a more like a national model, there are local incentives that come into play based on how the project would generate revenue or what that revenue piece would look like. And that's when the Illinois Shrines, formerly known as the Adjustable Block Program, comes into play for specifically when we're talking about DG Solar. And then if we're talking about utility scale, then we run, or IPA runs the index rec procurements, which is essentially your power and rec combined bundled agreement, which is how most utilities sign up for the power purchase agreements with PPAs with the state. So these environments can really impact the financing or like the outcome of the project. And yeah, happy to jump into. There's a lot of factors that we did address in today's webinar because we wanted to keep it very high levels for an audience that may or may not be aware of how projects are financed. But yes, we can definitely either jump in more about how projects or how the financing would differ for particularly projects in the state of Illinois, or how that revenue piece differs, or even if we want to go deeper into one of the aspects that we discussed in today's presentation. Like Rohan and I both said, there's a lot of nuances here that we can jump into.
Great. So it looks like we are getting some questions. I'm just going to go ahead and pose these questions to you both and whoever wants to answer this. The first question is from Maria. She's asking, how is transferability if credits changing the tax equity capital stack?
Do you want me to go?
Yeah, I'm happy to go. So that's a great question, Maria. It's I think in general, the tax equity structure has been pretty complex for the longest time. So it's kind of funny because of where the legal structure landed. Tax equity investors had to take risk before they came in. So it's a very common phenomenon we used to have in the past, which is the project was built, it was financed, it was constructed. You just couldn't plug it in and get power flowing because you didn't have a tax equity investor. And they wouldn't come earlier in the process because they didn't want to take too much risk. So they typically came just before you plugged in. It's now a lot more liquid. And what that means is if you're not able to find a tax equity investor to come in, which tends to be these very institutional banks with a very high bar of the quality of a project they require and documentation they require, you can sell the credits in an open market and you'll probably get less. So for example, if it was 30% of $100 for the capex, you might not get all 30, you might get, let's say, $25 or $27 against that, but you can at least go ahead and switch your power plant on. So it's made the structure a lot more liquid. It's made the market, especially for small projects, really small distributed generation projects, which is what this webinar focused on. Hopefully that helps. Chandrika, if you had anything to add.
Yeah, I just wanted to add that I think one more thing to consider is, and as we're seeing this play out, this will probably shape differently. A lot of these larger developers, so a couple of trends that we did talk about that we do want to mention if we're talking about transferability of tax equity or tax credits. A lot of these smaller players are actually getting gobbled up by bigger players, right? That's the industry Rohan and I were in previously. What that means is the larger players are not necessarily the ones transferring the tax credits. They already have large partnerships in place with giant tax equity providers already. And it's more efficient that way if you already have the structure in place. Tax credits are more, I guess, for smaller DG developers that have to go around looking for financing, and that basically it's a question of what's more efficient? Is it more efficient to maybe only get 25% in tax equity through tax credit transfer? Or is it more efficient to just find a financier and set up that transaction and adhere to all the US tax codes and set up that partnership? So I think that's where it's changing, where there is that option now, but it comes with its pros and cons depending on where you are in the game. I don't know if that helps.
Yeah. Thank you both. So it's 12:55 and we have two more questions. So I think we can go ahead and take these two questions. The second question is from John M. How punitive is the current interest rate environment for viability of these types of projects? Is there something that can be done state levels?
Yeah, happy to take, and then Chandrika, welcome your thoughts as well. So the short answer, John, is very, very punitive. Typically, when you think of, I think one of the pages we had is the cost of capital is getting cheaper. We were a bit in the twilight zone where the equity, and so what should happen is your equity is a little more expensive and your debt is a little less expensive. So you want to bring your debt in, so you take your more expensive capital and use it elsewhere. There was a while, and it may still be the case, where the debt is more expensive than your equity. So it's having the same impact that you see in the home market, which is it makes no sense to put debt on or to take debt. So there's just a lot less buying and selling of assets, or people are just using equity like cash payments like you have in the home market to fund their home purchases. It's very, very comparable. What can be done? I think anything that can be done to increase the value of the asset, so the credits which come from the state help offset that. So if like the cost of capital is one piece of it, but then the other side is what's the value of the asset. So if the asset is of a certain value and the cost is too high, people aren't going to invest. But if you're adding credits or you're adding incentives at the state level, which is offsetting the cost, it may still make sense to start bringing in debt. Again, relative to cost of equity, maybe not, but the more incentives or the more lucrative the investment, generally the more you're able to invest despite a high debt environment.
I will add, as a state policy person, what this means and what developers can do real time to make sure that the increasing cost, that we're able to still build projects and create the value or increase that value. We have, as I've stated in the webinar, we have something called the Illinois Shrines Program, correct, for specifically DG Solar, formerly known as the Adjustable ROC Program, which works on what we call a CREST model. This is a public-facing model developed by National Renewable Energy Laboratory and REP. The IPA puts out this model for everyone to see. Our input assumptions are visible. So if the developers are seeing that the debt now costs 10, 11% instead of the 6 to 7% that it used to build this project, please comment on this model. Send emails to me, send emails to Megha. Please provide us this feedback so we can refine our assumptions. And what that means is if we are factoring in the most present environment that we're in today, that means the REC prices that the state sets will change based on the environment you are giving us feedback on. And what that means is we will be able to create that higher value. The state will be able to design an incentive program which matches the RPS goals, which matches what we want to achieve, all of our goals, and therefore create that additional value because the costs have gone up. So if you are in that environment, if you're a developer working here and you see higher costs or higher labor costs or higher interest rate that we have not captured in our model, please let us know and please share that feedback so the state can design their program appropriately.
Thank you, Chandrika. Thanks, Rohan. One last question from Sarah Duffy. Would any of this look different if the project owner is a nonprofit or public entity?
Do you want me to take that, Rohan?
Yeah, please go for it.
Okay. So I think two things. If the project is a nonprofit entity, that essentially means they don't have taxable income, which essentially means they will definitely need to bring in some of these players, your tax equity developer or tax equity partner. I think all of that will just be dependent, or all of that only changes from a tax perspective. So in order to get the highest return for the project, and I'm not talking from a certain capital provider's point of view, I'm talking as a whole value that the project creates. To maximize that, we want to be able to monetize all the incentives that are available and capture the right cost. So if you're a nonprofit entity or a non-tax paying entity, you definitely want to get the best outcome, to get the best price for the power that's generated, whether it's in the form of a PPA, whether it's in the form of purchasing the project. If you want the highest return from a financial standpoint, you want to bring in partners to monetize all that is available to create the highest value for the project.
And I'll just maybe add, I think I agree with Chandrika. It should just get easier with the new IRA and the transferability of tax credits. So you might not have to have a complex tax equity structure. You might take a bit of a financial hit, but just be able to sell the tax credits or transfer the tax credits rather.
Great. Thank you. Well, I was just looking at our time. It is exactly 1 p.m. So with that, I would like to conclude the webinar for today. I really want to thank our attendees and speakers for joining the session and taking time to provide such great insights. Again, this webinar wouldn't have been possible without the support of our stakeholders who take such keen interest in joining our webinars. So thank you all and have a lovely weekend. And we will see you all at the next webinar on April 26th on climate change and health equity. Thanks.
Thanks all.
Thank
Thanks,
you,
Megha.
everyone.